Here we are looking at Gary's Tuesday report, the blue chip investor. And what we're looking at today are three important things. One of them is that all-time consistent. We're trying to find the best opportunities within the market that he's putting into his portfolio. The other one is an update on the indices, and they've been powering on exceptionally strongly, high, and many of them up near their highs. The question in that becomes, how long does a bull market last, and what do the cycles tell us? And that flows into the third point, where Gary's going to share with us decades of research of understanding the cycles and the key levels, lows and highs that we're going to look for in this week's report. So it's a lot to cover. And to that we say, good morning, Gary. How are you?
Yeah, no, I'm great, Chris. Yeah, we were talking earlier there. Maybe we're going to start from the back first and work our way back, which is actually a great way to look. Oftentimes we look at the market and we'll try and look forward here, but sometimes the best way to look at cycles is actually to work backwards. So look at when, your key lows and maybe key highs might, or most often sort of come in, and where the strongest sort of timings are, and then start to work backwards from there. Because the market goes through, like it takes a while. Like every top comes in a certain manner, like kind of one or two different varieties, and every bottom comes in with one or two different varieties, and they take a certain amount of time. Each of those tops takes a certain amount of time, and bottoms and a bear market takes a certain amount of time. But we do know that the midterm year is synonymous with that 4-year low. So if you think about our presidential cycle, that's our 4-year low. So the strongest 15 months come out of that October midterm year. So if we go back and look at the 4-year cycle there, the strongest 15 months comes out of the October low in the midterm year, which is obviously next year, 26. But if we go back and look at all the midterm years in particular, we see a lot of October lows, and we see a lot of June lows as well. Anyone who studied the 10-year cycle, which is like the years ending in 6, you can see a few there. Ending in 6, there is that
October lows are common.
Yeah, October and sort of mid-year does as well. So they tend to, 6 years sort of tends to be sort of weak in the first half, and then finishes strong at the end. So there's quite a dominant pattern there. So if we're looking forward here, so something like an October or a June next year would be the most likely, most probable, most common from a statistical point of view. So those are two dates we're sort of going to work backwards. So you can work backwards. If you study all the prior moves down into those October midterm year lows, or even those June midterm year lows, they take at least 6 to 9 months to play out. You don't normally get, the COVID sell-off that we've seen, and even that 45-day tariff sell, those are very unusual. A normal
Just on that, when you're saying that the 9 months, you're talking about from the previous high to then the eventual low. That's what you're talking about with the 9 months. Okay.
Yeah. You'll probably find that most of those October lows in the midterm year, they probably peaked in January of the same year, and then it had
that's the 9 months that you're talking about.
That would be 70-80% of those would have peaked around there and then fallen away for 9 months. And then usually the first 3 months you get you pull back, but you get maybe a higher low, 1 or 2 higher lows, and then you start to sort of break down. And the next 6 months is probably a bit more bearish, and then obviously the last month or two is probably where the heat of the move is. It's a bit like
the capitulation.
Yeah, it's like a base building as well. We build a series of high lows, and then when we break out, sit on top of high, then we run it, and we're spacing, and then go. So bear market's kind of similar. It'll form a series of
lower
highs, break down, come back, retest, then get aggressive, and then So, but we need at least 6 to 9 months. So if we're working back and saying, okay, October and June are most likely, we're looking at either January or maybe in something like October, if it's going to sort of fall in there. And because January is the most common, and every high normally is like a quarter increment as well so like in the 1965, which is the 60-year cycle, which has been probably the most dominant cycle there, it sort of peaked in November, and rolled off pretty hard. So it didn't peak in January the next year. It peaked in NOV 65. But what's most interesting about that 65 pattern was that high went like from the prior high to the I think the high before the high. That was exactly 180 years, and then it pulled back, and then it retested, marked the November high, a quarter year from the previous high. So sounds funny, but a lot of the highs will come in increments of 1 quarter year or half year from a previous high or low. So that's the one thing we see all over and over again. So one thing we're seeing at the moment, really interesting, is that we've gone straight up here from April sled on low, and October 6th, I think, is exactly 180 calendar days into this high. And we've had no breather. There's been, I think I went back and looked at it. I think 4 days was the most amount of down days we've had. 4 days, maybe 2-3 days, and everything else is 2 or 1. There's not even a full week of retracing here. So 26 weeks, we've only seen 4 days down the row up once. So this has been a really, really, strange, very, very strong market. I mean, that's a big, big gain, big move there. So we're hitting a really important time cycle. So these quarter year and half year cycles are sort of how a lot of tops come in. So whether they come in from lows or previous high, So it's just interesting here. I mean, if we measure I looked at the 65 prior low, and that would, if we measured exactly the same time in the 65-year cycle from its like 62 or 63-year low, that would net out around November 25. So we're within a month of that bull market, which lasted, I don't know, 37, 38 months or something like that. So that was a fairly long one as well. Whereas I saw Fidelity put something out there in September talking about the average bull market was 30 months and around 90 or 88%, 90% or something like that. So we've now moved beyond the average. We're 37 months. So we're now looking at, there's markets.
We're in the far side of that belt.
Well, yeah, we're above average. So we're well and truly above average, and we're above average in terms of performance as well. It's actually been a bit laggy here. It's taken a while to get going here, but this last leg's kind of made up for it. So, we do know that oftentimes the last leg of the bull market can be like 50% of the entire range all the time. So, and the stock's like 360, where the last leg up here has been something like 75, 80% of the entire range. So you're seeing those really aggressive blow-off moves into the top here. So I'm just seeing a few signs there telling me, ooh, be very careful here. We could be getting very close. I mean, we're already basically past the, like most of the averages, where we're sitting in the 10 percentile in terms of sort of length and stuff there as well. So yes, some have gone longer, but not that many. We've had a really super aggressive move here without much of a pause as well. That's pretty unusual. And we've gone a full half-year cycle into this top as well. And that's something we do see quite a bit of. So when I went back and looked at some of these cycles as well, I noticed that to go back and look at that sort of 26-week cycle, or I just edged it. It was 25.8 weeks there. I come up a bit stronger resolution on the daily for all the lows. And it actually went back to the 2021 high there. So if we look at, roughly 26 weeks from that high, that sort of found the low, something in between a low, and now high. So it's had really strong resolution this cycle, this sort of half-year cycle. So it's been pretty strong here. So people will probably dismiss these cycles. They don't really get it. I say, but I just keep saying these over and over again there. So I went back and looked at some of the prior cycles there, and I did show the one below this one, Chris, is a longer sort of cycle as well. And you can see here that this is like 132-week cycle from that 2000 top in the NASDAQ to the bottom. And then the full 132 and even half of that cycle found every low, every high, low, high, and it found the 2007 high right on that increment before it rolled off. So that's why it's sort of like when you look at the range of that cycle, you've got to look at the half and the full increments, so that moving forward, because that's sort of when the market will peak and drop. So it's done exactly this. He's hit every sort of top and bottom, top. That's why you got to respect those cycles. They're just sort of something interesting there, particularly when you look at ranges. And we know that, and we showed this on the S&P going back a few months ago now, is that 2007, 2009 bear market, the range of that range, if we expanded at 100%, 200%, that was finding every top. Sometimes that found the top for the next year, and it took 6 months before it pulled back, and the 200% hit as well. So everything goes off these higher bear ranges. So this is what I think this is one of the things that maybe Gann talks about, squaring price and time. If you look at the time of these bear markets, you can then look at square the ranges and square the time. And that's what I think he was referring to. Other people look at other sort of rationales around it. But from what I've seen here, this is, I found it, definitely some really good symmetry in there. So you're always looking for symmetry in the price ranges, and you're looking at symmetry in the time ranges as well. And time's kind of poorly misunderstood there, but there are some really dominant cycles in there. And as we live in, seasonality, so we do the same things over and over again, and sort of there's, we have our quarter year cycles, we have our half year cycles, full year cycles. Everything we do operates around these cycles normally. So, they just rush through the share market. So I don't know why they work. All I know is they do work here. So we just kind of got to respect them there. So there's a little bit of timing here right now for the NASDAQ and for the S&P 500. That is a little bit concerning to me, and considering how vertical we are. And we're also on that sort of shorter term chart there, maybe the first NASDAQ chart there, we can see that we've now expanded 150% of that range. So I think I sort of highlighted in the previous weeks, not many have expanded past the 150, maybe only one or two have gone to the 161.8. A couple have gone to the 150, but most of these big pullbacks and then expansions have only gone to like the 125 or the 138. They haven't gotten this far normally. So again, we're kind of in rare air as well. So, look, we can always go higher, Chris. We can always go longer. But there's a lot of symmetry right here, right now, from a cycles point of view, from a timing point of view, from a price point of view. That's like telling me, we need to be really careful here right now. This could be an important week here for the stock market, viewers market there. So just got to put that in context there. Will we pull back to the old high, which we sort of did in the 60-year cycle, then go back for a retest to the high, or will this, or is this the start potentially of a bearish phase, which might take 6 to 9 months to play out, which is the normal length of time that they typically do take. So it could potentially start here soon. And we're only a month away from the 60-year cycle as well. So, so just going to be pretty cautious here. I think the market's getting very extended, pretty frothy there. We just saw some of those GameStop and some stocks there last night, some speculative stocks up 10% as well. So we've seen all the smalls. We've gone through the gears. We've gone big caps. We've gone mid caps. We're now seeing the smalls just on fire here. The last couple of weeks, we've seen some of these small cap names have just gone unbelievable. And it's just, hard to trade these sort of 5, 10, 20 cent stocks, but they've had a crazy run here. So
they've definitely got the strongest momentum we've seen in 14 months. It's just
so we got all the signs there.
very rare.
Just gonna be cautious there. So look,
and extending this into the Aussie market. So obviously we do have a decent correlation with the US market, but we do dance to the beat of our own drum in the sense that we have different geography, different topography, and we pull a lot of dirt out of the ground and sell it overseas. Yeah. So we can have sort of step out of sync like we did in 07, 08 and that kind of thing.
Yeah.
How does that cycle look for Australia? Because as you've mentioned, we've got the small caps running amok. They're the best momentum that we've seen in a very long time. They're shooting the lights out. They're hard for you and I to trade under the 50 cent mark. They don't show up in the index, but they can in the sense that if the commodities are running, they can actually help the BHP, the Fortescues, South 32s, which can sort of offset some of the falls like we had almost 20 years ago.
Yeah.
What does that mean for the Aussie in the context of what you just described to us in the cycles?
Yeah, we could be delayed. We could run a slightly different. We normally end up catching up, or we've shown recently that if we lagged, we caught up in the end, and then if we led, we might be caught up by others. So you definitely can get that. We can get out of a little bit of step there, and if we look historically as well, sometimes the lows and the up can vary by the. So sometimes you sort of see it. You see it in the US market. You might sort of see a lower or higher low a few months later, and then in the Aussie market we might see a lower, or vice versa. I think like that. So commodities is probably that's probably the only interesting sort of space here, because that is sort of typically does do pretty well in inflationary periods. So when we know that precious metals, energy in particular, have done pretty well there. But we're sort of seeing, the one thing I did see in the last week, Chris, I saw some of the defensive sectors like the healthcare, sort of staples, and that, even some of the infrastructure stocks, that they kind of look pretty interesting here to me as well. So they've all had a pretty decent pullback here now. So stocks like Sonic and CSL, Ramsey, sort of Helios, so just a lot of those healthcare names have had a pretty big pullback here. Woolworths has had a pretty big pullback as well, some of those staples. So less so on the infrastructure, where there's still a few infrastructure names that look interesting as well that have been squeezed down as well. So with that sort of go back historically and look at when growth's been peaking, the inverse is those sectors have been finding loans. So we've sort of got the same things happening here right now. So
I'm interested that you say that, because this morning's research that I haven't shared with you yet was finding the top theme on the launch pad right now, and it's healthcare space. So cardiac, neurology, oncology, cancer, and diagnostic equipment, radiology. So they're all really high. They're filling up most of the top 10 on the launch pad. So I'm interested you're saying they're looking oversold, because they're showing a bit of a flaw creating in them. But digressing,
they might need to build a base and stuff here. But yeah, I mean those are the sectors that typically look at there. I mean, look, we talked about the 70s inflation a few years and what sectors did well, and they've all done pretty well. I mean, the only exception there is maybe growth has been stronger than it was prior.
And historically, yeah.
Yeah, but then you can argue that, that the internet has, has propelled earnings to that sector more than it was ever known. I mean, the technology wasn't even around in the 70s, really. So, like all these companies, so it's a little, that's the only sort of difference there. But yeah, it's just interesting here. I guess the Aussie market is sort of, got to be a little bit cautious there. I guess to me, the financials look pretty extended. The growth looks extended, and gold looks, that is, and if you study, so if you look at gold too, it doesn't tend to sort of, like, it's a bit like growth, doesn't sort of find highs and then congest, or, you know what I mean? Like those growth stocks and gold stocks, they both do a lot of V-shaped highs. So they basically go straight up into the high and then just come straight back down, and sort of, so there's a lot of V-shaped lows and V-shaped highs, and those sort of sectors. Financials do tend to maybe top a little bit more. But yes.
If anyone wants an example of that, you've got a great drone shield video from about 12, 18 months ago when it topped out, and it did exactly that. And that's growth.
Yeah, they don't muck around. That's the 50-80 rule, as we know. So yeah.
And when you're looking within the portfolio, what to add in this part of the cycle, in the context of, yes, it may not look great in the medium to longer term future, you're still putting things in the portfolio. You still have clients that want to be invested. They're still hunting for opportunities. AIA's in your report. We've looked at it before. Auckland International. What's the update happening with Auckland here?
Yeah, so it did shake me out there last week there, but it's left a bit of a false break here and reversed pretty hard on volume sort of coming in here. So it still looks pretty positive there. Is in that infrastructure area, Chris, as well, in that sort of one of the sectors which tends to sort of do well when growth is starting to cool off here. So just interesting here that this looks like it's trying to build a bit of a base here, but still maybe that breakout there the last couple of weeks there didn't sort of go on with it. But it still looks pretty supportive. That volume's pretty good. The in between week was pretty lighter here, so yeah, just looking for maybe looking for a slightly better entry here on this. So definitely one I still quite like here. So
We've also mentioned
range,
see it back in this range and see how it trades. Woodside. So you mentioned energy in your report as well. Back to that old support zone. So it's had the 0.123 bottom, which you've been really great at trading, and I know you traded them a lot through this part of the cycle about 6 months ago. It's come back up, hit some sort of resistance, and then retracing. I guess we're looking at 50% of the range is sort of. Is that where we are?
Yeah, we're around that range. We're also around the sort of left shoulder here as well. So, we potentially might, not that I'm a big head and shoulders fan here, but we do get that type of setup here. So we've had that sort of ABC correction there. I think the volume is definitely sort of starting to lighten off a bit here. Just the price action just starting to tighten up on the dailies a little bit. So if we see a bit more support come in here, that's the one to keep an eye on there. Just noticed a few, we seem to be just rolling through energy stocks as well. So as in through the sectors. So, oil and gas has a run, then it cools, and then uranium will have a run, then it'll cool. Lithium have a run and cool. Coal's had a run and then cooled and then run again. So it's just we're kind of going through the gears in that sector there. So that's still, like the one thing here, you look longer term here, is just the energy requirements. There's just no way of dancing around that. What AI is going to do here is put a lot of pressure on those areas there. So it just looks pretty bright. So every time they sort of pull back, we should be waiting for it to maybe try and build a base there, tighten up, and look for low risk entry.
Nice. Well, Paladin Energy, one of the other gears you're talking about, the uranium space. Looking at the weekly chart, it's showing the April lows, the rally, and then you've got this ABC. So sort of, let's see if I can highlight this. And so the A, the B rally, and then the C, where A is about the same length as C, it's come back off that, and then congested under the old high or thereabouts. This is the weekly chart, and pushed through. What does this mean for you and your trading at PDN, this setup?
Yeah, I think the sector looked pretty buoyant there. It's just, seeing the spot price. And you're just seeing obviously countries around the world start to, just sort of shift the Iranian policy and nuclear energy as well. And that's it's just one area that we're just seeing clear future demand here. So it looks pretty positive. The sector looks pretty robust. It's definitely shown some relative strength out of that April low, and then had a few. But when this has done a sort of a cap raise as well, which I thought might sort of knock it around a bit, but it actually held up pretty well. I thought that was a really good sign actually that to do a cap rise. And if you remember, Drain Shield did a cap raise as well, and it pulled back a little bit, held up really well. And I thought, well, okay. So it's a good sign. Yeah, it's almost a sign of relative strength when you actually do a cap raise and the share price is well supported. Because oftentimes that attracts a bit of selling. People get the cap raise at a bit cheaper, they sell the stock down, but the stock holds up. It's sort of showing you that what the cap raise is for is a market likes here. So the price action looks pretty bullish here. We've got a position here. I've got a stop in place there, so I still think it looks pretty robust there. So we just stay with it, and just breaking through the top there looks pretty positive as well.
Nice. Well, the next one in here is Karoon Energy, staying in that energy space. It has had, in the daily chart, a bit of a rapid sell-off to where it's been. So dropped from the range. So sort of 3-4 days up, 1, 2, 3, 4, 5, maybe we're on the 6th day now, coming back down to the range. Is this sort of a Davis box in reverse kind of thing, where you're looking for the rectangle, 3 touches? What's the signal here?
Yeah, looking for probably one more high low there too, Chris, as well. So it's sort of got the 0.112 at the moment. So we've got our low retest and then a higher low here. So sort of got base building type of characteristics. And what I've noticed is really some of those down days have been very light volume. So even though we've sort of drifted all the way back down here, it's been very little selling in that pullback there. Just a stock that sort of seems to be sort of trying to base here. So again, I think this energy sector kind of longer for stronger here, stronger for longer. But it's, just a sector to be able to look at there. So if we start to see this base here build a series of high lows there, definitely a sector to be having a close look at there.
Nice. Well, then we've got Nufarm, different sector, but it is trailing down near the bottom. We know that you do like to trade your momentums, but what is it that's caught your eye for Nufarm here after such a rapid sell-off and huge volume? What do you want to see happen with Nufarm?
Yeah, I saw a few guys talking about this when it did get sold off pretty aggressively, thought it was overdone. But then we saw the big volume there. So it was almost exhaustive into that low. And then we did see a nice bounce out of that low. But then it has kind of retreated here. And so now we've used up more time, Chris. So we've come back just as much time as that bounce. And it hasn't gone to a new low. And the last couple of weeks in particular, we've started to see an increase in volume there. So that's going to be the first sort of higher low here. We'll see signs of accumulation possibly coming in here. So just some early signs here that we might be seeing sort of potential first signs of accumulation there. So yeah, again, I'm just watching this one here, but price action sort of interesting here at this stage. We know when we have that washout low, either one of two things happens. I mean, if we get a bit of a bounce, we either come back and go, like your spring there, you'll go marginally lower and then you start to build, or you'll basically make a higher low build from there. So they are sort of two one-off sort of technical setups if you are build the base here. But the stock's had a pretty decent down run here, so it might take a little while to build, but you might just be seeing the first signs of a first high low here. So that's potentially constructive.
Well, CSL's another one that's had a bit of a down run. It's dropped the ranks in the ASX for quite some time. It has been a leader, and we're looking at the weekly chart here. So falling from 310, 12 months ago to 190 lows, sort of 210-ish. How do you look at that into a portfolio? The idea value comes up, but at the same time, we know you look at and you're not sort of consistent, you're not bottom fishing, you like your momentum. So how do you?
Yeah, it's sitting out the decline. Yeah, I mean, look, breaking through that 230 zone, that's probably that's obviously not a good sign when you break through, a low which has been tested a couple of times before. And yeah, so that's obviously since then it's gone quite a bit lower here. Probably surprised me how deep it's gone. Actually, I thought it might have come back to 200 or something like that, and then maybe bounce from there or something, or maybe even 210 there. I thought maybe it might, look like a bit of an overreaction at the time there, but yeah, when you break through those key levels, you just don't know how far it can go here. And this market, unfortunately, we're seeing that stocks that are running up are probably overdoing it, and momentum going a lot higher than everyone thinks. And then on the downside too, we're seeing some good companies get sold off, and then they're actually probably going a lot further than a lot of things most people think as well. So we're definitely seeing that momentum go both ways. So the bearish and so that can obviously produce opportunities. But from here, we're just interesting there that we saw those healthcare sector bounce there. Just a few names there start to show a bit of strength there. So some early signs are okay there for the CSL. So it's had a bit of a bounce here, I think 4 or 5 days, Chris, out of the low so far. And then we've had a couple down days, the last couple of days. And the one thing we saw like an outside day yesterday, which looked pretty negative, but there was no volume. There was very light volume. So we've got another day today here. I know we're only an hour in, but the volume is minuscule as well. So we kind of want to see that sort of maybe that Ramsey's or that ResMed set up there where you sort of get a low in place and then you start to build a bit of a base here. So I think CSL, even Sonic as well, they're some pretty good quality companies there that have had a pretty, solid sell down here, potentially oversold, but we do want to sort of see a bit of a base there. But those stocks are definitely, we know in the past, these stocks tend to find lows here when growth's peaking. So we feel like we've got signs of that. We just want to see these signs base here. So this is a sector that I'm watching pretty closely there, just because we are seeing a bit of strength here. And in the past, you sort of think the market's all runs together, but it just doesn't. We know that there's sectors that will do well at certain times. There's seasonality issues. There's just the market dynamics of moving through the gears. So we know there are sort of laggards. We know there are sectors that tend to do well late or that maybe go against the grain. So that's why we're looking at this stock here, because we've sort of got that classic oversold signs there, and we've sort of got the first signs of maybe as a base. And you can sort of see there's 5 or 6 heavy weeks there, Chris, as well. And if you go back and look at most of the deep lows, you'll get that breakthrough. Then you probably go another 3 to 4 or 5 weeks of heavy selling. And then that's the sort of, particularly when it's been pretty aggressive, that's often how the lows do sort of come in. So you do sort of see those elevated volumes. Then that shows some people are panicking out of the stock, and then while others are buying stock, because that volume that's both ways. So you've got as many buyers and sellers there. Someone's got to be taking out the side through that sort of period there. But it can be, when you see those elevated volumes there, it can be pretty interesting on stuff.
Yes, well, that's a good insight, and to understand, because so many people are looking at CSL from their portfolios as being a large one on the ASX. So there are a lot of people who want to know about it. And then we just come back to, I'll put this on screen for the 4-year midterm cycles. Something that we will put at the end on the right-hand side here is a link to that 40s and 70s inflation research that you shared with us some time ago. We've got a whole video on it where Gary's explained it. So we'll put that to the right-hand side if you want some more depth to understand all of those different sectors that Gary's talking about. They don't all run at the same time, but they can have their time in the sun. And to that end, we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.